Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. It is June 24th of 2022, and I'm glad to report that here over the last few weeks, we've started to make some progress, both in the market, but in particular with what's working underneath the hood of the market. So while the market itself is only 5 or 6% off its lows, we've seen many subsectors that have been leading the charge. And we're going to go through all of that today and how really that deflation basket within the stock market is actually beginning to show signs of leadership relative to the inflation basket. So if deflation is leading inflation, what does that mean for the economy? What does that mean for asset allocation? And what does that mean for our client portfolios going forward? So as you can imagine, the title of this week's presentation is Here Comes Deflation. And we're going to go through three key topics. One, we're going to take the temperature of the current economic environment and what that means for our portfolios. What are asset prices telling us about the path of inflation going forward? We know it's a hot topic right now. And lastly, can your portfolio grow in a low growth world? Now, I want to do a quick performance update here. Now, the performance update is specifically looking at how the portfolio is performing since the growth portfolio that we manage, put in its low on May 24th. And the only reason I'm bringing this up is not a pat on the back. We have so much work to do when we look at our performance year to date. But what we're trying to show here is what is happening with the nature of the bear market that we're currently working our way through. You'll notice here that opportunity strategy is a growth strategy. We invest in growth stocks. Growth stocks have been leading the charge to the downside for most of this bear market that really started, when we think about it, all the way back in February of 2021. It was only when the bigger stocks such as Google and Microsoft and Apple started to participate in the downturn that we saw the broader indices move lower earlier this year. Now, for the first time though, something has changed. The S&P 500 over the last month from the end of day, May 24th through to June 23rd, not including today, has moved down an additional 3.7%. But the opportunity strategy since that point has advanced 15.6%. So in other words, growth stocks have started to move higher, even though the market has continued to move lower. And we can see kind of anecdotally why. Energy stocks are down 16%. And that's a symptom, broadly speaking, of what's been taking place in the commodity world. The commodity world is showing signs of collapse, whether we're looking at lumber, cotton, oil, natural gas, you name it, across the space. Anything that's tied to factors driving inflation have started to roll over and come down. And that's a huge, huge event for us. And we're going to go through why this week. But from an economic perspective, this is another reason why we're seeing commodities move lower. U.S. consumer data, whether we're talking about retail sales or we're talking about consumer confidence, has continued to move down. That has fed into a manufacturing slowdown. So we look at Philly Fed, the Empire State Manufacturing out of New York, or overall national U.S. industrial production. We're seeing a broad weakening across the board. And then lastly, but certainly not least, housing has also began to slow down quite dramatically. Doesn't take a genius to figure out why. Mortgage rates have gone from 2.8% all the way above 6%, while prices haven't come down. The affordability of the U.S. housing market has taken a dramatic hit. All of this feeds into slowing economic growth. Why is that important to you as a growth investor? Why is that important to us? Because if we think back to our playbook at the beginning of 2022, our overall annual call was for inflation and growth to peak out. That got delayed by the by the Russian-Ukraine war, because that kept inflation higher and for longer than we expected it to. Now that the intensity of that war is starting to come down, notice what's happening. This overall call that we had at the beginning of the year is starting to, at least we think so, it's starting to play out. So as inflation and growth peaks out, we expect bond yields to come down. Now, what's happened? We've seen the 10-year go from 3.5% to 3%. We expect the economy to slow down We're now seeing evidence that the economy is slowing from that 5% level at the beginning of the year all the way down anywhere between 0 and 1%. What does that mean for stocks? In that type of environment, historically, commodities and cyclical stocks do terribly. That includes value stocks. They do not do well. They tend to go down in price quite a bit. Secular growth stocks have a tendency to outperform because investors want to find stocks that can grow strongly in a low to no growth economic environment. And since the supply of those stocks is quite narrow, investors are willing to pay more for those stocks. So you see rising valuations, and that feeds into a rising price. Now, over the last week, we have seen signs of forced selling across the stock market. So if we look at the percentage of stocks above their 200-day moving average, all the way down to like 12.8%, we see that in terms of the percentage of stocks trading above their 50-day moving average, all the way down to 2%. Does this guarantee a low in the stock market? Absolutely not. Well, what it does tell us is that we could be, from a historical standpoint, in the ballpark of a low. And when we're in the ballpark of a low, we kind of want to be out there chipping away at some of our favorite stocks. So that's kind of the way we look at the overall market. And we know from a historical standpoint that bear markets, the bottom of a bear market is a process. It's not a day or a price point, right? So what does that mean? The ultimate low, once the ultimate low of the market is put in, we've already seen many individual stocks start the bottom from a historical standpoint. So in 2008, March 09 was that ultimate low, but many stocks, whether we're talking about energy stocks or tech stocks or material stocks, they actually started to bottom back in October and November of 2008. That was when you actually wanted to start chipping away at some of the stocks you think would have, you would think that may lead the next secular bull market. In this case, tech was obviously the winner. So what you want to do is say, A, are there areas of the market that are not making new lows when the market is? And remember, this month, June, is important because the market made a new low, but many areas within the growth area of the stock market have not made new lows. We want to identify those areas and themes that are acting well during a bear market, right? So within that growth upturn, are there certain subsectors, whether it's biotech or Chinese technology or cloud computing, that are acting a little bit better than their overall growth peers? And then obviously find those individual stocks that are leading the charge. So we're going to go through some charts here. And I have the broad question that I want to ask everyone that's on this YouTube video is this inflation? Natural gas, this is the price chart of natural gas, down 33% off its peak. Is this inflation? Russian wheat embargo. What Russian wheat embargo? Wheat's down 33% off its peak, believe it or not. Everything we read in the press says wheat's going through the roof. We're actually in a severe bear market in wheat. Is this inflation? What is Dr. Copper saying, right? Copper being a main economic driver when we think of industrial production. Copper is down 24% despite the fact that China's coming back online. So again, we ask ourselves, is this inflation? A picture says 1,000 words. Even oil, which has quite possibly the most attractive supply-demand dynamics out there, it's down close to, and this is actually a couple days old, this chart, it's down close to 18% off its 52-week high. So again, we ask ourselves, is this inflation? And the truth is, when we look at all of these factors, cotton down 35%, lumber down 60% plus off its peak, the market's trying to tell us something. The symptoms of the market are trying to tell us something, that there's actually a lot of disinflation going on underneath the surface of the market. While the CPI reports are telling us what inflation did 1 or 2 or 3 months ago, what's happening today is disinflationary when we look at these asset prices. Then on the flip side, we look at biotech. So biotech went from pariah to darling. Over the last month, what we've seen is that biotech has outperformed the S&P 500 by close to 23%. So is that inflationary or disinflationary? Biotech tends to do well in a low growth environment, in a low inflation environment. We look at China. Chinese technology stocks have outperformed the S&P 500 by 67% since March. And it's a big weight in our portfolio right now. So we ask the question, is this inflation or deflation, right? So those typical deflationary assets that do well are technology stocks, are growth stocks in general, biotech, healthcare. These stocks are acting better than your inflation basket. We look at the IPO index, whether that includes SPACs, traditional IPOs, young, earlier stage growth companies. It has outperformed the S&P 500 over the last month by close to 20%, up 19.2%, 19.24% since those May relative lows. Again, the market's trying to tell us something. So overall, what does this mean? As the Federal Reserve slows the economy down, we know they're doing that. They're increased interest rates another 75 basis points. We expect another 75 in July. Our original playbook, while it was early, but delayed because of the war in Europe, may be starting to play out here, knock on wood. So the three big takeaways, it does appear that interest rates are beginning to slow the US economy. We are seeing commodity prices basically collapse, with the exception of oil, still a moderate low, despite the war in Russia. So despite all the bullish developments that are taking place, we're seeing commodity prices collapse. That's a very important symptom. And then lastly, we want to look for stocks that can grow in a low growth environment. Quite simply, we want to rotate away from value stocks into growth stocks, because growth stocks tend to do well in a low growth environment. No one is really positioned for that right now. The consensus trade out there on Wall Street is long value, long oil, long commodities, and short growth. The pain trade, in our opinion, in the back half of this year is long growth, short value, short commodities. That's what we got for you this week. If you have any questions, please feel free to reach out to your advisor, or you can reach out to us here at LifePro here in San Diego. Otherwise, have a fantastic weekend. And again, if you have any questions, please feel free to reach out. Thank you again for all your business, and have a great weekend. Talk to you later.